That was, a really a big game
Right.
type of win.
Right.
Yeah.
And Johnny, you're at almost 300-year-old bank. I mean, how do you guys view this? Is it out of need? Is it out of desire? I mean, how are you thinking about it?
So it's a bit of both, but there's a sort of another area that I think is very relevant to this. We have hundreds of suppliers, and they're all the big names. You mentioned any large IT company, and for me, the engagement with the startup community is not as well as, and I don't think that the banks have fully woken up to the idea that it could be instead of. And we're seeing people like Capital One who are going down that route. We say often we've bought everything that every one of these large companies has ever sold us, and yet we're still not happy. So the startup community is not as well as, we run, let's say, for example, 1,300 applications. Ross isn't going to pat me on the back for adding 2 more in that they're startups. We need to start thinking about decommissioning some of this stuff and maybe weaning ourselves off some of the crack that these suppliers are selling us and replacing them with. And I mean, startups are not just startups. I mean, let's be honest, App Dynamics, until they were recently acquired, we used to refer to them as a startup. I mean, they just got 4.3 billion in cash. The party hasn't ended yet. We can hear it from our office. So, we're on Second Street. They're not a startup. They're a big company, and a lot of the ones we deal with are similar.
Mm-hmm. Sam, you're kind of in the throes of these guys as well. How are you guys viewing this? I mean, you're doing it as a kind of front running and testing and seeing how those startups can perform. Is there synergies that you guys then really see making something from?
Yeah, so with the accelerator program, we try to stay away from the idea that we only focus on fintech. In fact, we kind of look at anything, which is, I hesitantly say that because when we open applications again in a few months, we do get some random corporations and some random bakeries, but we also get a lot of cool, interesting companies. And some companies we've looked at in our portfolio include like Context 360, which started out as a video game company. Mm-hmm. But what they did in their offering, we found different use cases throughout the bank. So with every single company that applies, we can't necessarily say, hey, this isn't for us, oh, hey, this isn't a direct need. It might be a need to catch up, it might be a need right now, or it might be a need in the future. So in terms of teaming up and what we see together, I kind of agree with everyone here where it says like the regulation and the backbone, I mean, we can withstand all of that. We're big enough to withstand that. But I mean, sometimes you gotta think ground up a new age to come up with new user design and what do you want? Like a good example would probably be like P2P payments. I mean, we all kind of knew we wanted it, but Venmo came along because we wanted the social aspect. So there's different little bits that we can't all think about on our own, but when we team up with others, I think the expression was, there's a lot of smart people in Wells Fargo, but there's a whole lot of more smarter people outside of Wells Fargo. So we need to bring them all together and see what we can do together.
Makes sense. And CS, from your perspective, how are you viewing this ecosystem interaction with your bank?
So first, for us, we're a little bit different. When we're looking at companies, we're looking at slightly larger. We're looking at companies that have a product developed. And for us, because there are some operational risks when you're working with startups that that haven't gained a lot of traction, for us to unwind that. So for HSBC actually looks at more strategic partnerships with these startups. We're looking at companies that have the product developed where we are a client of theirs, and at that point we are looking at strategic investments and kind of leveraging that relationship. Going back on some of the things that the panel was talking about, I mean, there are risks with working with banks. As with any other investors, it might not be financially aligned. A lot of times, I think someone mentioned that the banks may be working and so dependent on these startups that they may not support other products or other directions that the founders like to go in. So from our perspective, those are the kind of things that we're seeing, but a little bit different from the rest of the panels that we're looking at a little bit more mature startups to bring into the bank.
Cool. So Steve and Jessica, let's take the inverse of that. What are the things that you see in these large financial institutions that you say to yourself, boy, if we had that, we could really kick some ass? I mean, what are those things? Is it, as Michael pointed out, is it data? Is it access to capital? Is it infrastructure? Just money?
Money. They have money, they have people, and they have lots of customers, and they work in many parts of the world. And so the hard part is that when you go into a bank with, like when I go into a bank with my proposition, it's like, what's the use case for that? And I keep wondering whether I should just say, okay, let me just focus on the use case that they understand, and bring it down to their level, or as people like to say, dumb it down to their level.
And by them, you don't mean anybody here. You mean
No. But you also find guys who really get what we're doing, and then they'll tell you, look, let me be honest with you. Yeah, we totally agree. Once you get all the developers on your platform, we're going to be there. But until then, why should we move? Why, we got a nice, cozy banking business. It works okay. You're kind of like upsetting the apple cart. And because in a way, I'm kind of like how the music business changed, right? We had CDs, and those were selling, pretty well. And then digital music came out, and people were wondering, like, are we going to make the transition? But the music companies spent a long time debating whether they make the transition from this technology to CD technology to digital technology. And we saw this with banks too. When the internet came on, and banks, it only took them 10 years for banks to realize that the internet was there, and that they should have a web presence on the internet. Only it was like 10 years from the first bank to most of the banks on the internet. And so if I was to go to a bank and say, hey, I got this great idea, it's called the internet, and there's gonna be this web browser, and it'd be like, okay, so what's the use case for that? Oh, you mean that people can access my bank easier? That's gonna mean it's gonna be easier for them to switch to my competitor. So why would I do that? And so it's very difficult to sell this new technology to a bank, which is why there's schmucks like me that are doing this, because the smart guys know better. And so everyone who's experienced in this, including the VCs who turned me down for financing, all knew that what this guy is doing is totally impossible. And so you have to believe, it's like the Steve Jobs quote, that you have to, it's the crazy, insane people who change the world because the other people are too smart to, they know that it's so impossible. And so I just, I went into this with eyes wide open, and I heard of the warnings, and people would, tell me what you're doing is impossible. And I said, no, I think, this is so compelling, they have to get it. And of course,
You're still at it.
well, yeah. So you have to be really, really clever about how you package your proposition to the bank. And so what we discovered is that banks really care about control of the customer. They've always cared about control of a customer. And when you have open banking, it's more about customer satisfaction than it is about control. But of course, they're still stuck in the control of the customer. So you appeal to them by saying, hey, look, let me give you a technology that will enable you to access other banks. But in return, I want you to provision our software on the bank, and that's the quid pro quo. And if you do that, then it's my Trojan horse.
So I think the other thing you might want to consider is going to Europe, because
that's why I start.
Yeah, okay, because in Europe, the PSD2, which is really forcing the banks to open up the APIs.
Yes, but
is opening up.
And each bank has a different API. Right. So far, we have 15 banks that have published APIs. Each one of them is different, and BBVA actually has multiple versions. So, as a software developer, it's just a nightmare.
Yeah. So on another side of that, I mean, you guys are not dealing with them, but I still want to know, if you could, what is it about the banks that would be most interesting to you to, again, kick some butt?
Sure. To take a different tack on this, trust. As a startup, yeah, for early adopters, of course, they're going to try to use us to send money to India or wherever. But then you get to the next level, and I don't want to lose my $1,000. I don't want to lose my $10,000, and it's figuring out how to convince them that, hey, we are fully regulated. We've got the money safeguarded. There's even if TransferWise were to go bankrupt, that money is completely protected. And what the banks have is sort of 300 years of legacy. If people have heard of the name, they trust it. That we are working really hard to build up. And actually, we spend a lot of time working with banks. And so for us, we would not be possible without banks. We have, in each of our markets, we need at least one bank in each of the currencies that we serve, and usually more than one bank. That enables us to do payouts and receive money also in each of the markets. I wanted to go back. These guys all said, it's great to work together. From a startup's perspective, when it makes sense to stop working so closely together with the banks. At the beginning, it makes a lot of sense. There's a lot of things that we can learn from each other. After a certain point, banks actually are quite conservative. As surprised, but yeah, they are. And so for example, there are certain things that take the UK as an example. We have this bold vision. We want to get to instant payments. But if you always have a bank in between you and paying out to your customer, it's never going to be quite instant. And so the right way, or the way that we got around this was, okay, in the UK, let's just integrate directly into the payment system. And so when you get to a certain point and you start to understand exactly where you can push, that's when you should start thinking about, okay, how do I take over some of these things that I used to rely on a bank to do?
Oh, that's a great point. Yeah, and to John's point about are these things startups? $116 million raised. So you guys are a big startup, and it's interesting to watch you guys continue to evolve. But again, kind of in this arm's length relationship with the financial institutions. I'm going to ask one more question, and then I'm going to send it off to the audience. So start thinking about something you might be curious about. So there's been a lot of investment in the space. I think since 2012, 72 rounds of financing, $3.6 billion into 56 fintechs. What is really pushing the banks to this investing model into this? Is it kind of as Brian is dealing with right now, the notion that an option on the future? Is it it's just a way for them to test opportunities? How are banks thinking about the investing side of this? So that first.
Sure. I think so. BBVA also owns a venture capital firm, Propel, that's here in the city, which is not constrained to fintech investing. I think there's a line in which you evaluate that as a pure investment, similar to what Sam said at Wells. It's like, you don't have to be doing banking in order for me to be interested in that as an opportunity, as a place to put my money, right? And I think that banks are willing to place bets, obviously, that they think are going to be disruptive as a defensive play, right? So if you're going to come disrupt me, I might as well get smart about it and at least be educated when you show up at the gate with your army. I at least know what weapons you're using and how to fight you a little bit. Or if I get lucky, one of them becomes my army and I buy them, and you're in the mix. You're in the conversation. But I do think there's a line there between kind of investing in something else versus building something. And I think the core answer to the short answer is not very good at building stuff, right? It's really hard to do inside of a large organization, not unique to banking, it's just the size of an organization. Innovators do want to write a lot of pre-existing works out there on that concept. I think that's it. I think it's really hard to build inside large organizations. You have two options. You can create new ones, or you can invest in others. I think that's the biggest hurdle that they're trying to overcome.
Oh, John?
Well, to Steve's point, we've got some money still, Steve. We've managed to lose quite a lot of it over the last 10 years, but we've still got some.
I'll be there next week, John.
I don't actually have it with me, but I did ask, actually, when I came to Silicon Valley 4 years ago, I said, just to check, do I need to bring some cash? And they're like, well, yeah, maybe some dollars. Now, I was thinking, no, if we find these two kids in a garage with baseball cap and a can of Coke and a PC. It's like, do I just need to give them some love and that'll be it? You know, it doesn't really work like that. So we've stuck to that, so I don't do that. But we only invest for two reasons. One is if we can't get access to the technology or the knowledge without making an investment, and there's only been one example of that, and that's in the quantum computing space. And the other reason is if we want to help the company to develop a solution that we're going to use. So it's not necessarily an investment, it's more like oiling the wheels to make the thing happen. And we may or may not take an equity stake at the end of that, but it's helping that company along the way. Other than that, we learned in our first week, firstly, you don't need to bring any money, and if you do, there's a danger of this thing called dumb money. And we learned that that's a very bad thing, so we don't do that.
BNY Mellon is a little different. Well, we're sort of like you, John, in the sense that we're not investing very actively. At least we haven't so far. Now, I think some of the preconditions for investment are now there. I mentioned this API layer, and now that we have that, investments make a lot more sense. But we've only had that since, for the last, like, say, 6 to 12 months. And so some of the preconditions for the investments to really pay off weren't there. Consequently, we didn't do that much of it. Basically, our model is, I built a team of 65 engineers in Palo Alto. So these are Silicon Valley engineers and data scientists. And we deliver code. So we're actually like a product startup inside the company. So rather than us going investing in startups, we're kind of building our own innovative products we seem to deliver. Now, the one case though that I'll mention that is kind of interesting is for secure messaging right now among all the Wall Street firms, there's a product called Bloomberg. You've all probably heard of Bloomberg terminals, and there's Bloomberg chat. That's what the traders use. There is, it's not as secure as it should be or could be, basically, and so forth. And so Goldman Sachs came up with a project that was a start at a secure messaging capability, and they spun it out as a startup, and they got a few venture capitalists came in, but a whole bunch of banks came in. I think like in the first round, there were like 10 banks maybe that invested at the order of 2 to 3 million. A couple of banks went in larger, but essentially it was a syndicate or a consortium basically kind of model of investment. And they created a startup which is now in Palo Alto called Symphony, which is basically working on secure messaging among Wall Street firms. And so that's an interesting model too. But the compelling need there was the fact that all these banks have this network effect in terms of their need to interoperate and their need to communicate, and they all wanted a better, more secure way to be able to do that. So they kind of all came in together and said, let's go do it. So there was a very compelling case for the investment, but it was kind of also a unique kind of circumstance.
So with Wells Fargo, there's quite a few different ways to invest. And I just found out not too long ago, we actually have a green tech lab as well. So we have so many different funds across it. To answer your question, why is there so much activity in the space? I think it's actually to prove the point that banks are interested in trying to innovate and wanting to, and understanding that startups do have a lot to bring to the table, and not just going after our customers or the money or everything like that. And I guess to the point of, with our investment activity at the accelerator, we're primarily focused on putting our money where our mouth is. So if we said we wanted to try your technology, we wanted to see what it could do, well then we're going to, actually invest. And unlike other parts of Wells Fargo, we don't ever really make a public statement about the relationship. The accelerator actually is allowed to. So we do publicly announce when we do invest in a company. So that's kind of one of our biggest value adds. But for really, it's to establish that foothold with the relationship with the company. So we invested, we do something with them, and then we kind of set them off. If they want to go elsewhere, it's non-exclusive, so they can go wherever they want. But if they want to come back, they actually have a few points of contact, and the investment's kind of like we do have a pretty good relationship at that point.
And for HSBC, we're, again, a little bit different. We look at this as more of a strategic partnership. So for us, we have to be a client of the company. And at that point, we're looking at making an investment and being part of the conversation. We're not looking for control. Over the past few years, we made about a dozen investments. And again, we're helping these companies kind of have a more global view and utilize our footprint and help them grow. So that's really where we stand and when we're looking at investments with these companies.
Cool, thank you. Does anybody have any questions?
Hello, everyone. My name is Luz Gonzalez, and I am a co-founder of Convive. And my question has to do with what are you learning from the leapfrogging that's taking place in emerging markets? I think when I go to fintech events, I get a little bit frustrated because we talk about American fintech or fintech that's taking place in the developed world, but we're not talking about what's happened in Kenya, what's happening in India, where right now what's already happened in the Philippines, what's happening across Africa. So what lessons are you learning from the emerging markets?
So I lead our Asia business. It's something that's pretty close to my heart. I think that the coolest thing that we're seeing, at least that I've been able to see in a lot of Asia, is that there is a lot of sort of new innovation and new ways of thinking about customer pain points. And for us, what we're trying to do there at the same time is to do the same thing, which is listen to what are the challenges, localize our product in order to meet those challenges, not necessarily just take whatever it is that they're doing in Europe or doing in the United States. And in many of these cases, we think about partnering with wallets, with different sort of money management companies, robo-investors, advisors. And so like a lot of these things, we try to listen to what our customers are saying and then figure out how we can work together in order to give them the product that makes the most sense.
Just real quick there, somebody mentioned earlier that maybe it's instead of and as opposed to in addition to. I think that's one thing that we can learn from some of the emerging markets, which is sometimes there's actually a better way to do it. You don't need landline phones, it goes straight to cell towers, right? I think that's the leapfrog effect. And I think when you see examples of that in banking, you're able to take that back and go, oh, maybe I really don't. Maybe there is another way to do that. And even if there's regulatory or technical issues in, say, a developed market like the US, just the fact that you know that it can happen gets you thinking about it a little bit more. And another thing which I think is a big risk right now in the States is margins, being willing to do the business for a little bit less money or for a little bit smaller customer. That's one thing that I've certainly taken and that is a part of the strategy for the business that I'm building, which is there's a lot of people in developed markets that are severely underserved, right? They don't need to be overbanked anymore. They don't need any more banking. They're not really served very well because their average loan size isn't very big or their average deposit balance isn't very big, and they're just kind of forgotten about. And you see business models in emerging markets that really make those types of customers both happy customers, but they also make the company some money. And I think that those proof points, at least for me, are really telling about what you can do in more developed markets.
Just really quickly, as a bank, we've downsized and pulled out of a lot of the emerging markets in terms of business, so we're focused on a dozen or so predominantly European countries. But as an innovation function, I've just taken on the role as the global head of our innovation and scouting teams, and what we have to figure out is how we tap into those markets, and I don't think it's going to be the same as we've done here, for example, where we put people like Neil and myself on the ground, but we do need to be able to take the innovation from emerging markets, China, India, Australia. I mean, every country in the world is saying they're an innovation hub now, and figure out how to get the quality into our pipeline, not just more quantity. So it's, if you've got the answer, tell me later, but it's definitely a challenge for the second half of this year.
Just a couple quick examples. There's a company in Brazil that's revolutionized insurance sales. They basically have an API-based marketplace. Unfortunately, their name escapes me right now, but they have a really revolutionary model for how you buy. I mean, I won't go into all the details, but there's this whole kind of supply chain of insurance basically with their model and so forth. And so I met with them, and then we thought a lot about what the implications of that were for API integration using them as a model. And we're actually we're talking to them about partnering and so forth, which is, I should remember their name, so sorry for that. The other examples, we have been thinking a little bit about the kind of underbanked, unbanked problem in Africa and what the implications are of that for like how you do KYC. So there's a fundamental banking process called Know Your Customer KYC, and you know, it's right now it's still based upon these centuries-old traditions of, well, you know, I knew the guy's mom and I knew the guy's dad, and now I know the guy, you know, that kind of thing. Or you go through this painstaking kind of interview process, and you document everything meticulously and stuff like that. But that doesn't really fly in a nation where, you know, at best people have cell phones, but there's no branch office. There may not even be a post office in the village. I mean, stuff like that. And so to be able to transcend the underbanked and unbanked problem, to be able to bring banking to these people, and they need, you know, they want it. They want finance. Also, you have to be able to think in smaller chunks in terms of microfinance. I mean, to get to the point, to get back to the point you're making about smaller scale and trying to make sure that you can be profitable at smaller scale with smaller deals and stuff like that. You have to think a little bit differently about the opportunity, but there is a huge opportunity, and it will grow, you know, from there, you know, so you don't want to miss out in some sense as the economy starts to take off and digitize. So there certainly are things to learn. It's a good question.
Another question?
Yeah, so any more questions? And what we'll do is whoever in the panel feels a burning answer, please respond, because unfortunately...
Or we'll just pick you at random. So.
Unfortunately, because we've got such a huge panel, thanks to me, we're going to have to minimize the responses. So next question.
Can you give us a few examples of highly profitable fintech companies that you've seen around these days?
Okay, who's going to answer that question?
We have the highly profitable fintech company. Please stand
Come
up.
on, you guys. Whoever feels a burning urge to respond, please.
I mean, yeah, there's plenty of them out there. I mean, I think not by quantity, but by quality.
Can you name a few?
Stripe comes to mind, right? I mean, there's a few out there that are not in the physical space that are able to make money, right?
SoFi.
SoFi is a good one.
SoFi.
In lending. I mean, some of the alternative lenders that have gone public.
And SoFi is actually making money?
Yeah.
You know, I mean, the folks, Lending Club and On Deck and the alternative lenders that were able to go public on, you know, on those books were certainly profitable when they did. I think the fintech is a pretty broad term, and I think there's a lot of little companies who think they can make, you know, who see this much of a window of inefficiency, and that's not going to be a billion-dollar company, right? And I think that the bigger opportunities are probably coming, and we aren't seeing them yet. I would say that some fundamental shifts are going to show up with how money can be moved, and the people that get that right are going to be the first, you know, the equivalent of the first banks on the internet, and they are going to make some money because, you know, the next internet is coming. I think everybody that's building stuff on top of the existing infrastructure, expecting to be the next Square, which is kind of a, you know, sounds like Stripe, but isn't proper. So, and those guys are, I mean, amazing innovation there too. I don't mean to knock that at all. Like, you know, you got to give a huge respect to what happened there, but building more on top of the existing rails, there's a limit to the amount of that's left, right? There has to be more fundamental shifts to unlock big pieces of value, I think. So I don't think you're going to see a lot more building on top of the old rails that become billion-dollar profitable companies.
Next question.
Actually, adding on to what you just said, everything seems to be focused around money transfer and money payment systems in fintech. What other areas that you see have opportunity for innovation?
Who wants to answer that?
Yeah, I'll take that. I mean, I just would say it's every single area. So if you look at RBS, we start out with a personal bank, a small business bank, commercial bank, private bank, an investment bank, 12 brands across 14 countries. Every single area of our business is under attack and therefore is rife for innovation. You know, every problem in every customer sector, and then if you add in payments, security, data, just those three, you know, everything.
There's actually, a great, there's a site called CB Insights. CB Insights, and if you go look for an article that they posted on disaggregating Wells Fargo, and what they do is they take the retail homepage and show you startups for every one of those menu items. And they show you like 5 or 10 startups for each one, and you realize, wow, there's really a lot of people going after the market here.
Yeah, I would love to add something to that too. So I was talking to a few people earlier. Santander recently, they leaked an internal slide from, I don't know if you guys have seen this, but they leaked an internal slide, and essentially it was about payments. It was about money transfer, and it essentially said that banks cross-subsidize a lot. So they give you free ATM access, all this free stuff, but then they make a lot of money in other areas. And what's happening is that a lot of fintech startups are looking at each of those areas, let's say it's mortgages or it's payments or whatever it is, and saying, there's a lot of money there, I'm just going to do that. And then they cut the price a lot, and then the banks can't actually compete because they're trying to cover the cost of the other things that they're offering for free. So if you think about where the opportunities are, it's in each of those verticals, and especially the verticals where the banks are making the most money today.
One quick add-on to that. So I love that slide, by the way. It shows how much money Santander is not going to make if prices are all transferred. I think that's the 1/8 slide or something like that. That's coming. So I think if you fast forward a few years, new technologies are going to severely compress the margins on the areas where banks make money and they shouldn't, right? And I think kind of radical transparency, and this is a big piece of what we believe in at my company, where we think there is still a lot of innovation to happen. Banks make money because they hold your money. Safe harbor, like, not always honest with you about that. I'm going to charge you these other fees for moving your own money and for getting money. Like, the incoming wire fee blows my mind, right? You're going to charge me $10. The money just showed up. You didn't do anything for that $10, right?
But they had to add it to the.
Somebody, yeah, and it's that kind of stuff that's going away. Banks are not going to continue to get away. The first banks to really embrace that and come down to the competitive margin on, say, an international transfer, they still make some money, but it's kind of more of a fair margin for the amount of regulation and work and back-end, processing that goes into it. And I think that you're going to see a lot of that in those areas, and then they will compete more on the core, right? Safe harbor for your deposit, my willingness to lend you money at the right risk, at the right rate, like those are the core aspects of banking. It's going to get closer to that, I think, because the startups are nibbling away at the fat. And the fat is making 8x what you should be making on an international transfer or charging me to receive money into my own account. Right? I think those things are really ripe, and if you see those areas, they're going to go fast.
Any more questions? We can, one or two.
Hi guys, my name is Drew. I run FinTech strategy for StanChart over in Asia. Can we talk a bit about regulators for a second? We've got lots of global banks here, we've got a couple of startups. Sit down. I'll keep it easy, I won't put anybody on the spot. Many of you, TransferWise as an example, Token as an example, are choosing to work in certain areas and not in others. How much are regulators dictating the innovation that can happen from the startups and the innovation that can and can't happen from the banks? And can you give any examples of where that's working in your favor and where that's not? Don't all speak at once.
So for us, regulation works in our favor because the European Commission, in their infinite wisdom, has decided to tell banks that they must open up their APIs, and so there is a mad rush to do this, and they have basically about 3 months left. So that's super helpful to us because it gets people's attention, and we can go into banks and say, hey, instead of you spending $50 million to develop your own solution, let us do it for you for only $10 million, and you'll save $40 million, and you repeat that with other banks. And so the regulations can sometimes be super helpful to fintechs. That's an example.
Just a comment on an upcoming, an upcoming situation, but all the regulators right now are actually really scared of AI because regulation is predicated upon transparency, and with some of the AI technologies, at the end of the day, someone can figure it out, but they're pretty mysterious and they're really not very transparent. And that's actually, so they're all kind of scratching their heads about what the hell are we going to do about this, basically. So that's keep your eye on that.
You're patient to wait.
Okay.
Sorry.
So one more question.
I wanted to ask you about innovation in the area of commercial credit and analysis, things like revolvers, lines of credit, and if you guys have seen anything interesting there.
So just to add to that, we are going to have a credit panel coming up, so watch your newsletters. I'll get someone here to answer that question.
I can jump in here, and I think we were talking a bit about the opportunities that fintechs have. I think a lot of it's kind of been in that consumer space, but there hasn't been a lot kind of that B2B space where we see a lot of opportunity. I guess for us, we've seen in terms of that credit space, we look at AI that companies that can actually help us with our risk management, and that's been pretty exciting. It's just really kind of what you touched upon of how do we get to that decision trees and being transparent. But we are seeing some operational efficiencies there with the amount of data that we have. But definitely utilizing AI to help us with that, with those spreads.
Anyone else there? Okay, so I just wanted everyone to give a big hand to this panel because